Hi, this is Sadiq Adesha, Chief Investment Officer for Sun Life Global Investments. As we begin to settle into a new normal, the markets are still showing signs of heightened uncertainty. In March, we saw the CBOE Volatility Index go above 80, which is quite extreme. Lately, it has been in the 30s and 40s, but that is still double the long-term average. As we move into the next phases of the pandemic, we continue to manage risk while looking for opportunities for the longer term. Join us as we present part 2 of our Quick Take series. At Sun Life Global Investments, we go through a rigorous process to select and monitor sub-advisors from around the world. In our Quick Takes conversations, these sub-advisors provide important insights into their regions or asset classes. We hope that this diverse coverage will help you manage and stay informed through this period.
Hello, and thank you for joining me as I speak with John Mahoney from MFS Investment Management to discuss the Sun Life MFS International Value Fund. John, can we maybe start by getting your thoughts on how the international equity asset class was impacted by the events in Q1?
Thank you for the question. It was interesting to see how international equities reacted during the first quarter relative to U.S. equities, but maybe more importantly is how the asset class has responded since the sell-off in March. Just for comparison purposes, the S&P 500 fell almost 20% in the first quarter. The MSCI EAFE index fell around 23%, so not a significant difference in terms of first quarter performance overall. However, if we look at what's happened since the first quarter, the difference is pretty stark. So through May of this year, the S&P 500 has actually recouped almost 75% of its losses from the first quarter, whereas the MSCI EAFE index has recouped about 37% of losses. And when you look at this at the index level, the biggest driving force behind it has been market structure. So the S&P 500 is more heavily tilted towards sectors that either held up relatively well during the sell-off or bounced back with strength just afterwards. Think of sectors such as technology, which is 24% of the S&P 500. International markets are more heavily tilted towards economically sensitive areas of the economy that sold off meaningfully and did not necessarily bounce back. So areas such as real estate, materials, industrials, and consumer cyclicals. Now, while international markets overall have not fared as well as the U.S., I do think it's worth noting that the experience of the Sun Life MFS International Value Fund investor was meaningfully better than the developed international index investor through May of this year.
Are there any sectors or regions that are more attractive given the sell-off we just saw in Q1?
Great question. I do think it's important to reinforce that our process is one of rigorous bottom-up fundamental research on a company-by-company basis. So we don't necessarily make top-down region and country calls, but at the sector level, our active positioning is a fairly accurate reflection of where we currently have the most conviction and have found the most long-term opportunities. So for example, we've been meaningfully overweight to consumer staples companies, given their steady growth characteristics, and also technology companies that are dominant players in industry niches. That said, as an active manager, we're always on the lookout to add or trim names if the market gives us the opportunity to do so. And in fact, in March of this year, we did make incremental moves to trim some consumer staples and specialty chemical names that held up very well in the sell-off, and add to some technology and also some high-quality industrial names that came under undue pressure.
Aside from the adds and trims you just mentioned, and without getting into specific names, how is the team looking to position the fund going forward, given that some uncertainty still remains in the economy?
The team at MFS has been thinking a lot about this recently. Since that period of time in March where we found the opportunity to add a bit to some oversold names, the market has rebounded a bit, and so our trading was very light throughout April, given that we feel there's significant downside risk at these valuations. The sharp market rally since March has primarily been a liquidity rally, while fundamentals are very weak and very uncertain. So in that sense, there's no change to our very cautious mindset. It is likely that many bank loans will go bad, unemployment will be a problem for a long time, and big parts of the economy, including airlines, hotels, restaurants, leisure, and entertainment, will suffer for some time. That said, the fund's cash balance is a bit higher than average, which should allow us to step in and buy names on our watch list if the market declines and we have an attractive opportunity on valuation.
Thank you, John. I appreciate your taking the time to speak with us today.